I know many of you are looking at new holding stock and becoming more interested as the stock price is falling, thinking about buying the dip here. But before you do that, there's some things you should know about the company and its recent developments before you make a decision on new holdings. I'll cover those details in this video and what they mean for investors and shareholders alike. So let's take a look at the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So in the latest quarter, New Holdings has been developing introductions of new features for public payroll loans, and that will allow them to tap into more than 70% of the overall total addressable market for payroll loans in Brazil. Remember, Brazil is its largest market. They have roughly 100 million active customers in Brazil. So they're going to release the product for newly eligible customers, and that's going to open up more opportunities for loans, and that'll make the process a lot easier when they're locked into the system. It'll allow them to make those loans, and then they can actually tap into those for repayment of the loan. So it's a more secure type of lending if it's connected to individuals' paychecks in the public payroll. Additionally, there's been a reduction in credit yields. And you see this primarily a result of the increasing share of secured lending within our total originations, as secured lendings typically offer lower yields and lower risk than unsecured loans. Let me elaborate on that a little bit. Let me explain that a little bit. So when New Holdings makes let's say, for example, a personal loan, that's called an unsecured loan because there's no collateral attached to it. But when they make an unsecured loan, they can charge a higher interest rate because it's riskier. Okay. Now, think about a secured loan, which is something like, for example, a car loan. Now, that's collateralized with the car. So if you don't make your car payment, the company can come and repossess the car. So that's a secured loan. But those secured loans come with lower interest rates because they're less risky. You're not going to lose all the money that you lent because if your borrower does not repay, you can go and repossess the car or repossess the home or garnish the paycheck in the payroll loans, in example. So those that are less risky also offer lower interest rates. So in the latest quarter, New Holdings made more of the less risky loans, and so their credit yields reduced, but they're also experiencing lower risk. They increased the amount of loans that are lower risk. I tend to prefer that. I like those lower risk loans that are collateralized with cars and homes, especially. These are assets that people do not want to lose. And so it incentivizes them to make those payments. If they miss a payment, New Holdings can give them a phone call and say, look, if you don't make your payment in the next 5 days, we're going to repossess your car or we're going to foreclose on your home, etc. Not that they make those types of loans specifically, but I'm just talking about lenders in general. So I like those loans that come with collateral, and typically the interest rates are not all that different. In the United States, an interest rate for, let's say, a personal loan might get an interest rate of around, let's say, 12 to 16%, depending on the person's credit score. And then if you're thinking about a car loan, that can be somewhere between 8 and 12%, depending on the person's credit, right? So not that much lower to make a car loan that comes with collateral than a personal loan that comes with zero collateral. Now, that's the spreads in the United States market. My knowledge of the credit spreads in the Brazilian market is not as expansive, and so they might be a little bit different, but I don't expect them to be that much different because the same risks versus return are evident in that market as well, depending on the laws and how much um, leeway lenders have in repossessing assets when the loans are not repaid. In general, though, I prefer collateralized loans, even if they come with lower yields. And that's what happened with New Holdings in the latest quarter. They made more secured loans that come with lower interest rates. And while some investors might look at that and say, well, your credit yields decrease, that's bad news. I would look at it and say, no, it's not, because you're getting a better risk versus return on these secured loans than you're getting in the unsecured loans. So their total deposits for the quarter increased to 28.3 billion, which was up by 60% year over year. And the reason this is important for new holdings is because it's a lower cost of capital. The more deposits the company attracts, the more loans the company can make with those deposits. And depending on how much they're paying customers to make those deposits, meaning if their deposits are coming into savings accounts or if those accounts generate an interest for keeping your money in the account, and depending on how much they get for lending the money, that spread is pretty wide between what New Holdings pays customers to deposit money and what New Holdings gets for lending the money. And so the more money the company gets, that's lower cost of money, and then it lends it out, and that spread is what the company's in the business of doing, right? Attracting capital at low prices and then lending capital at higher prices. If you think about a company like New Holdings, you can think of it as uh, like if you think about a Walmart, for example. Walmart pays to get inventory, to get products into the stores, and then it tries to sell those products at higher prices. With a bank like New Holdings or a financial services company that does lending, they pay to get money and then they lend money at higher prices. So for a bank like New Holdings, their products are money. That's what they're buying. That's what they're attracting at lower cost with the deposits. And then they're lending it out at higher interest rates. So that's their business, right? Attracting money at low prices, lending money at higher prices. That's what they're in business of doing. And New Holdings has done a pretty good job in this regard. So at the close of September, their operations in Mexico reached $3.9 billion in deposits, 4 times more than 3 quarters ago. So Mexico is their growth market. This is where they are growing quickly, but it's not their largest market. Their largest market is Brazil. They're growing. I know they added 1.1 million customers from Mexico in the latest quarter. Now, compare that to Brazil, they added roughly 1 million customers every month in Brazil. So Brazil is their most important market. And Mexico, I would say, is their second most important market. And they're growing very nicely in Mexico. And the opportunity there is much larger than the opportunity in Brazil because they already have 100 million active customers in Brazil, or close to 100 million active customers in Brazil, whereas in Mexico, they have less than 15 million active customers in Mexico. And so you could see the size of that opportunity, the population compared to existing customers, compared to Brazil, population compared to existing customers. The opportunity is much larger for New Holdings in Mexico. And they are achieving very nice growth, as you notice here. And so if they continue at that pace, it could be another market that reaches the size of Brazil in terms of active accounts for New Holdings, which would be very positive for investors. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.